Good morning, Facebook. I'm Jill Malandrino with the Voice of America, and this is NASDAQ's Facebook Live. It was another record-setting week in the markets, although we saw a little bit of red at the open. Bill, thank you for joining us, as always, at the NASDAQ. We're going to talk about portfolio management in this environment. How has that been? Because the narrative certainly changes day to day now.
Yeah, it really does, Jill. From our perspective, we are long-term investors. We're not making tactical decisions. We are looking at a combination of off-balance sheet data, which relates really to companies' exposure to environmental, societal, and governance-related risks, coupled with strong underlying fundamentals. And we create these models, and we run them for a year and rebalance them quarterly. Right. So we're really not making tactical decisions about where we are sort of in the market cycle.
So you're not quite as concerned that, for example, financials are up about 28% since the election. Is that as much of a concern in this type of portfolio management, or it's strictly model-based?
It's strictly model-based.
Right.
As it turns out, we are underweight financials. We are zero-weight energy in the current cycle. We're heavily overweight in industrials and in consumer discretionary. Right. And last year we were heavily overweight in health. And so in some instances, actually, sector weightings overall helps us, but it's really, I think, it's the interplay between finding companies that are managing some of these risks, which are not typically what many portfolio managers look at, and attention to the underlying fundamentals that actually creates sort of the opportunities within the portfolio.
Well, it's been really interesting talking about sector rotation. It used to be a quarter or even annually that you would see these massive moves in the sectors. It's happening on the overnight for the most part. What was hot one week is certainly not the following week.
Yeah, that's right, but it could be hot again in 3 weeks.
Right.
So it's kind of hard to chase, what's happening in the market. And I also think that the Trump effect is, pretty interesting. I noted a few days ago that an analyst actually downgraded Under Armour because of comments that the CEO had made that were sympathetic to the president. And that analyst said, well, essentially that's not really consistent with a hip urban brand, and basically reduced the price targets on it. Yet on the other hand, you had a Nordstrom actually where the stock price went up as a result of getting into a bit of a dust-up with the president.
Well, I mean, I can understand what the analyst is saying, because that would certainly alienate your core customer base, right?
That's right, yeah.
But even though the tweets can make portfolio management or even reporting on the markets a bit tricky, because the narrative is constantly changing, especially on the overnight, I feel as if the more tweets you put out, you're almost diluting your message. So in a counterintuitive way, I was not surprised to see Nordstrom actually take off. It's almost like the little boy that cries wolf. If you say it so many times, eventually the message is going to be diluted.
That's right.
So I guess that's a positive. We could extrapolate from that.
That's right.
So let's talk about some holdings that you have. When you say that you're underweight financially, you don't have anything in energy, but you do like consumer discretion. What are some names that you're holding?
Well, more broadly, I'd say probably the 3 or 4 largest holdings in the portfolio right now are Mead Johnson, which was actually a very good name to be holding. We bought it at the beginning of this year when we rebalanced. We do a big annual rebalancing with the portfolio, and purchased it then, and it has since been, it is in the process of being acquired by a British company, so those shares are up, I think, 23% since the beginning of the year, and so that's our largest holding. Now, it didn't start off as our largest holding, it appreciated to become our largest holding. And there's 44 individual equities within the S&P 500 in our portfolio, and so on average, that's 2.25%, 2.5% a piece. So we really don't start off with significantly overweighted positions. Right now, I would say, in addition to Mead Johnson, Albemarle is a big, has appreciated pretty significantly, as has John Deere, the Gap, McKesson. Those are probably our 4 or 5 top holdings at this point.
Well, staples could be interesting, because we just got that news with Kraft Heinz and Unilever this morning as well. So I think you'll continue to see. Do you think we'll continue to see more M&A and consolidation within this space?
I do.
Yeah.
I do. I mean, our portfolio has benefited from it. I think in the last 2 years, there's been 4 acquisitions out of 40 holdings on average per year.
Right.
And so I think that's a bit of an anomaly. I mean, I'm not sure that's going to hold up, but it does seem as though there's continued appetite for.
Especially in the staple space. You
Yeah.
never really think of that as that sexy M&A takeover type of space, so to kind of get that news in there is interesting. Are you concerned at all about valuations within the space at all? Because staples is one of those sectors that you always think that they can be a little bit pricey, if you will.
Yeah, I mean, we're always concerned with valuation, but keep in mind our portfolio is really focused on, generally speaking, we're in the value we're in the value end of the spectrum. We tend not to have a lot of technology. We didn't last year, we didn't the year before. We have very little right now. And as I mentioned, we have zero energy this year, and we were significantly underweight last year. And so part of our methodology is actually finding segments of the market where the companies are not only thoughtfully managing some of these off-balance sheet risks, which are hard to identify, but at the same time are, tend to have sort of lower volatility to begin with. And I think that, prejudices us a bit away from, things like energy and tech, which tend to be sectors with much more inherent volatility.
Well, it takes a lot of the emotion out of the portfolio as well.
Yeah, there's zero emotion in the portfolio. Everything is rules-based.
What's the performance based, like relative to the S&P, if you look at it on the longer term? Does that strategy tend to play out more consistently?
Yeah, I think so. We have beaten the S&P, which is our benchmark, over 1 year, over 2 years, and over 3 years, and the beta in the portfolio is 0.63 since inception. So we are outperforming the market. We are doing it with significantly less volatility. And we are holding companies that, relative to their peers, are doing a better job of managing some of these off-balance sheet risks that tend to be environmental or societal or governance-based. And we're also creating some specific impacts in the portfolio. We have, on average, we have 23% greater female board members than the average of the S&P. We have higher corporate citizenship scores, which come through Corporate Knights up in Canada, which is our data partner. And we have 240% greater dependence on clean energy within the companies that we hold as compared to the S&P as a whole.
Because I remember when we spoke the first time, the difference with ERG versus socially responsible investing is you're proactively looking for these names rather than reacting.
Correct.
So.
Yeah, that's right. So we are looking specifically for companies who are best in class around specific key performance indicators that we think matter within their industrial sector. So stranded assets matters in the oil and gas space, but it doesn't necessarily matter, in consumer discretionary. Right. But in general, I think as, one interesting thing to ponder is what impact is Trump going to have on the style of investing that we're practicing and others are practicing. And keep in mind, there's $40 trillion of professionally managed money in the United States. 1 in every $5 has a environmental social governance either overlay or outright mandate. And it's growing at about 33% a year. So investors care about this. Businesses increasingly understand that this is important. I mean, businesses are preparing for a low carbon future. They're transforming themselves to be relevant and sustainable in the future. And as a result of that, I think, Trump is going to, he's a nightmare scenario from an environmental standpoint. I mean, he's doomsday, right? He wants to dismantle the Clean Power Act. He doesn't believe in, he thinks climate risk is a hoax. He's surrounded himself by people in real positions of power who are going to do everything they can to relax environmental standards, and they already are. Through something called a Congressional Review Act, they're now making it possible for oil and gas drillers to leak methane emissions on government lands and to dump mining waste into streams. I mean, these are the things that they're actively doing. But this is all really kind of a dance between businesses and their investors, and businesses increasingly get it. So more and more companies are disclosing their plans. More and more companies are linking executive compensation to, clean capitalism. More and more companies are allowing proxy access rights to shareholders, which is really creating, I think, a constructive dialogue between investors and businesses.
Right. And
so I think progress is going to continue to be made. And so while I personally think this market is getting a bit toppy, at the same time, it doesn't change how we think about it, and Trump doesn't change how we think about the movement towards a sort of a lower carbon and a cleaner economy and better corporate governance and greater transparency.
Okay, well, it's good to hear from businesses for sure. Thank you very much, Bill, as always, for joining us.